Let's talk about first the financial intermediaries. Financial intermediaries are the bridge of the borrower and investors. So meaning ito yung daan ni investors and ni borrower. So for example nito, ang financial intermediaries is like a bank. Kasi si bank will lend money to a borrower in order to buy the needs of the borrower. And bank open publicly for the people who wants to invest their money if they are willing na ipalago yung pera na kanilang i-deposit sa bangko. Financial intermediaries buy the securities issued by the deficit units for their own account. When you say financial intermediaries buying securities to the deficit or issuer, that means you are essentially lending money to a borrower. So for example nito, si bank will buy a securities to the borrower and they will expect to earn a return on their investment through interest or capital gain. Next is the direct and indirect finance. Direct finance, a borrower-lender relationship or transaction. Direct finance, the word direct means diretso ka na makakabaro ng pera. So like for example ito, nagborrow ako ng pera sa aking kaibigan at direct ko na ito mababaro without any financial intermediaries. Dahil nga si direct finance is no need for any financial intermediaries. Indirect finance is a relationship between the depositor of a bank and the borrower of the same bank. So dito, they use financial intermediaries. So as I said earlier, financial intermediaries are the bridge of the borrowers and investors. So for example nito, si depositor will invest money to a bank and that is called direct finance. And if the bank will lend money to a borrower, that is also called direct finance. So kung iisipin natin, si investors and si borrower is need pang makipag-transact sa or makipagrelasyon sa bank. So, hindi siya direct finance katulad na sample na binigay ko kay direct finance. So, it is called indirect finance. So, next slide will be reported by Ms. Samama.
Good day everyone, I am Aliana Sulaik Samama. I am going to discuss the old financial environment and the new financial environment. So the first one is the old financial environment. The U.S. Congress put policies in place to encourage a highly specialized financial sector after the financial crisis during the 1930s. Banks were founded to accept deposits and issue short-term loans, with a little branch expansion and interest rate control. Kaya, mas prefer nila dati yung short-term kasi less risky compared to long-term loans. The only securities that life insurance firms were permitted to buy and sell were corporate bonds. Due to this, people had to deal with various organizations for transactions and businesses that issued stocks and bonds were required to utilize investments, firms for assessment and commercial lending, institutions for loans. This resulted in a highly diversified financial system. The second one is the new financial environment. Due to the rising interest rates and inflation that contrasted with already existing regulatory frameworks, the OFE was affected in the middle of the 1970s. The assets and liabilities of financial intermediaries were subject to market-determined rates, and there was more uniformity across financial institutions in the new financial environment. As a result of this, the new financial environment, which is defined by financial innovations, practices, and products, came into being. Yung mga authorities were obliged to protect their economic and financial system. That's all. Thank you.
So we have the classification of financial intermediaries. So we have two basic categories. depository institutions and the non-depository institution. So, in the depository institution, this refers to financial institutions that accept deposits from surplus units. So, this primarily accepts and hold deposits from individual business and other entities. So, under in this, we have the commercial banks. So, commercial banks grant only short-term goals. So, the largest lender in commercial and industrial loans. So, sila yung nagsusupply ng mga funds sa traders, manufacturers, industries, governments, and other financial institutions. Next is the thrift bank. So, these are composed of savings and mortgage banks, stock savings and loan associations, private development banks, microfinance, thrift banks, and credit unions. So, sila yung nag-accumulate ng mga savings of depositors and investing them. Next is the rural or the cooperative bank. So, typically makikita sila sa mga rural communities. So, rural and cooperative banks are differentiated from each other by ownership. So, ang rural banks are privately owned and managed. And the cooperative banks naman is organized and owned by cooperatives. So, next is prior to 1994, the macro rating was used by regulatory agencies to go credit standing of banks. So, we have macro. So, it means management, asset quality, capital adequacy, risk management, and operating results. So, in 1995, we also have identified the CAMELS rating. So, CAMELS means capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to risk. So, these ratings, nag-aim siya ng determine in bank's overall condition at nag-identify siya ng mga strengths and weaknesses in terms of financially, operationally, and managerially. So, in each element is assigned a numerical rating based on the 5 key components. So, yung rating is a comprehensive rating with 1 signifying the best rating and 5 the lowest. So, next is the non-depository institution. So, ito yung mga issued contracts that are not deposits. So, for example, pension funds, life insurance companies, mutual funds, and finance companies like depository institutions which perform financial intermediations. So, under in the non-depository, we have the insurance companies. So, the life insurance companies are financial intermediaries that sell life insurance policies. So, ito yung mga premiums are used to purchase investment para lang makapay cash as needed. For example, when an insured dies, so meron tayong life insurance companies to provide protection over a contracted period or a term, which may be a year or 5 years or for a lifetime. Next is the fund managers. So, ito yung nag-include ng mga fund managers. For example, mga pension fund companies and mutual fund companies. So, ang pension fund companies is sila yung bumabenta ng mga contracts to provide income to policyholders during the retirement years. So, pension funds are set up to accumulate funds to provide retirement, disability, and lump sum death benefit payments to the employees of companies or labor union members. Sa mga mutual fund companies naman, is sila yung nag-engage sa mga mutual fund markets. So, sila yung nag-a-allow ng mga investors to purchase mutual funds that buy different securities in the securities market like stocks, long-term bonds, or short-term debt instruments issued by the business or government units. So, next is the finance company. So, these are profit-oriented financial institutions na nag-borrow and lend ng fund to household and business. So, by issuing securities in the open market and borrowing from banks and then re-lend these funds to households and businesses. So, securities dealers and brokers. So, sila yung naghahanap ng mga investors or saving units for the benefit of the borrower. So, they can only earn commission on any sale they make. Then, pawn shop. So, sila yung nagpapawn ng mga asset nila as a collateral in exchange of an amount of much smaller than the value of the assets. Then, trust companies or departments. So, Trust companies as corporations organized for the purpose of accepting and executing trust and acting as a trustee under wills as executor or as guardian. So, sila yung nag-perform ng mga trust functions for companies issuing bonds to ensure that bondholders are paid as needed and they can act as fiscal agents or paying agents for the government. Then lastly, the lending investors. So, sila yung mga individuals or companies who loans to borrowers like consumers or household. So, lending investors perform granting loans but not as big as the regular financial intermediaries.
Risk of financial intermediation. So, risk is the possibility that actual returns will deviate or differ from what is expected. So, magkaiba sa expected. Meaning, kapag ang financial decision or investments, meron talaga yung uncertainty risk na involved. Kahit na ganito yung expectation ninyo, possible talaga na walang guarantee na yung actual result is the same sa kung ano yung na-forecast ninyo or yung expectation ninyo. So, this uncertainty is a fundamental aspect of finance, and managing it effectively is a key consideration for investors and financial professionals. So, we have here financial intermediaries face several risks. So, first is yung interest rate or market price risk. So, interest rate risk is often referred to as market price risk in the context of fixed income securities. It is a significant concern for investors and financial institutions. It refers to the potential for changes in interest rates to affect the value of fixed income investments, particularly bonds. So this risk can impact both the price and yield of these securities. For example, bumili ka ng bond for 10,000 na merong fixed rate na 4%. So, you expect to receive 400 in interest income each year. Bale, ano yan siya? Yung 10,000 times 4%. So, few years later, yung market interest rate, nag-start siya magtaas due to some economic conditions or like nagbago yung central bank policies. So, anong nangyari? Yung market interest rate ngayon is sa bond is naging 6%, so tumaas. Ano ngayon magiging impact niyan? Dahil yung bond meron siyang fixed rate before na 4%, it becomes less attractive to investors compared sa bagong bond na nag-offer ng 6% yield. So mas mataas kasi. So ang result nito is yung market value of your bond is magdi-decrease talaga. So dito na tayo papasok sa reinvestment risk. So kapag naka-receive ka ng 400 sa interest income from yung bond mo and susubukan mo siyang i-reinvest in new bond, sa bagong bond, mapapansin mo na yung bagong bond it will offers a lower yield than your original bond's coupon rate. Yung gaya yung sinabi ko kanina na yung 4%. Ito yung tinatawag na reinvestment risk. Bale, as your income from reinvestment may be lower than expected kasi nagbago nga umakyat ng 6 tapos yung sa'yo dati is 4%. Refinancing risk. So, it is a financial risk that occurs when a borrower, whether an individual or a company, faces challenges or increased costs when attempting to replace or refinancing existing debt with new debt or credit facilities. So, this risk arises due to uncertainties in the interest rate environment, credit conditions, also the borrower's ability to secure favorable terms for the new debt. So, for example, meron isang company nag-i-issue ng corporate bonds na merong fixed rate na 5% interest rate. So, it was set to mature in 10 years. However, yung market interest rate is nag-increase by 7% in 7 years into the bond's life. So, the company can refinance existing bonds by issuing new bonds at the 7% market rate or seeking a new loan. Bali, ang mangyari nito is mag-i-increase yung interest expense and potentially affect the company's profitability. Nandito yung mga cash flow and financial stability. Kasi the higher interest expenses could leave less available for other investments or operational needs. Default or credit risk. So, it is also known as counterparty risk. So, itong risk na to, it is the risk that a borrower or debtor will fail to meet their financial obligations by not repaying a loan or debt as agreed. So, simply means na hindi lang nakapagbayad ng loan or utang. Purchasing power risk. Purchasing power risk, also known as inflation risk. Alam naman natin na kung ano yung meron sa inflation risk. So, it is the risk that the real value of your money or investment will decrease over time due to inflation. Hindi nyo lang napapansin. For example na lang, yung 10 pesos mo is nakakabili ka pa ng 10 candy before. Kasi tig 1 piso bawat isang candy. Ngayon, bigla na lang naging 4-5. Kung mapapansin nyo, yung value na 10 pesos is bumaba. Bali sa 10 pesos, 8 na lang yung matatanggap po na candy. Ganun. Yan yung purchasing power risk or inflation risk. Political risk refers to the potential negative impact on investments in businesses or economic activities due to political factors or government actions in a particular country or region. So, pwedeng dahil sa political events, decision, or developments. Kasali na rin dito yung pagpapalit ng government policies, conflicts, regulatory changes, and more. So, political risk can affect a wide range of industries and can lead to financial losses, disruptions, or operational challenges. For example na lang, ang Philippines, merong history of changing policies and regulations in the mining sector, which can affect the profitability and operational continuity of mining companies. So, dahil sa environmental concerns and the desire to protect natural resources, bali nag-strict sila sa regulations about sa mining. Anong nangyari? Anong impact nito? Sa mining companies, syempre magkakaroon sila ng financial losses kasi yung ibang mining companies is magsasara yan kasi nga talagang naging stricto sila sa regulation. Pag hindi sila sumunod doon, ipapasara yan. Bali, ayun, financial losses. O kaya, yung iba naman is magiging challenging sa kanila. Dapat mag-create sila ng mga long-term plans. Paano nila mababawi yung magiging possible na financial losses nila. Depende sa kanila kung magkukontinue pa rin sila. So, off-balance sheet risk. So, it refers to potential financial risk associated with items and obligations not recorded on a company's balance sheet. So, while these items may not be immediately visible in traditional financial statements, they can have a substantial impact on a company's financial health and performance. So, transparency, disclosure, and effective risk management are crucial for companies to address off-balance sheet risk and provides stakeholders with a comprehensive view of their financial position. Next, we have technology and operational risk. So it encompasses a broad range of risks associated with the use of technology and a day-to-day operational activities of an organization. Bali, yung risk nito is can result in financial losses, business disruptions, damage to reputation, and regulatory issues. For example na lang yun sa mga businesses na siguro naman halos lahat ng businesses dito is gumagamit na ng technology. So, if ever na magkaroon ng mga error, pwedeng, for example na lang yung mga scam, bigla nagkaroon ng bug sa system ni Land Bank, mga ganito ganyan. So, financial losses, pwede rin sa business mo, kapag meron kang sariling website, ganun. So, sa operational risk naman is about ito sa mga human errors, ito mga fraud, panloloko. Liquidity risk. So it refers to the risk that a company or financial institution may not have sufficient liquid assets, or sa madaling salita yung cash, walang cash, or easily convertible assets to meet its short-term financial obligation when they come due without incurring significant losses. So example nito is when a company has assets in excess of its debts but cannot easily convert those assets to cash and cannot pay its debts kasi nga wala siyang cash or wala siyang madaling i-convert, easily convertible assets. So ayun. Pwede rin isang example dito is yung kapag yung asset is illiquid, hindi siya illiquid, and kailangan siyang ibenta sa mas mababang market price. Yun yung isang risk ng example ng liquidity risk. Currency risk, also known as foreign exchange risk or forex risk. So it is a financial risk that arises from fluctuations in the exchange rates between different currencies. So syempre, anong maapektuhan dito? Individuals tayo, businesses, investors na nag-engage international, merong mga international transactions, ganyan. Kasi for example na lang dito sa currency risk is Philippine peso to US dollar. So kapag mangyayari dyan, kapag nagbago yung currency natin, magbabago yung value, affected lahat ng businesses niyan. So isa pa na example is kapag lack of strong and fair judicial system na ma-enforce sa contracts, at saka yung risk that yung government might prevent or limit money from being transferred out of the country to the business home country. So possible na maghihirap yung isang bansa.
Role of financial intermediaries in socio-economic development. In a developing country like the Philippines, financial intermediaries play an important role in its socio-economic development. These intermediaries help create efficient markets and lower the cost of doing business. It is the financial intermediaries that bring the available funds from the urban areas to the rural areas, which have the most need for such funds. Rural banks, cooperative banks, and microfinance thrift banks have been a great help in these disadvantaged areas. They are the ones doing the lending to farmers and other rural residents that need to develop their status in life. They can borrow from the rural banks, cooperative banks, and microfinance thrift banks and start their own small businesses or send their children to school. In addition, growth of commercial banks in the rural areas has helped the areas tremendously by making credit available to the rural residents so they can use the same to advance themselves. Entrepreneurship and micro and small industries had been pushed in these areas to help these areas develop and improve not only the economic aspects of the residents' lives but also their social life. Financial intermediaries had been a great help in the socio-economic development of these areas. Financial intermediaries had been influential and helpful in the establishment of schools, businesses in these areas, aiding in their socio-economic development. Financial intermediaries also help fishermen to buy bangkas or boats and nets for fishing, and also the government to fund their infrastructures for development. Moreover, these financial intermediaries have helped a lot of the rural folks escape usurers. So these usurers are the people who lend you money but at a high interest rate. Financial intermediaries had partnered with the government in its efforts to develop these rural areas and uplift the economic and social standing of the rural communities, and at the same time get rid of usurers. The usurers will flourish if the rural areas do not have the banks to help them in the fight against poverty. A financial system mobilizes the financial resources of society and utilizes this for social and economic development. Economic basis for financial intermediation. Financial intermediaries help both the surplus units and the deficit units. They help surplus units by pulling funds of thousands of individuals and entities, overcoming obstacles that stop them from purchasing primary claims directly. Such obstacles include lack of financial expertise, lack of information, limited access to financial markets, absence of many financial instruments in small denominations, and a lot more. The spread of risk is made possibly only by the pooling of funds. This is generally termed as diversification. Risk is spread by the pooling of resources. If borrowers default, several lenders suffer the loss, instead of just one lender shouldering the loss. Financial intermediaries also help the deficit units by broadening the range of instruments, denominations, and maturities of financial instruments, enabling even small savers or surplus units to take advantage of the safer and more profitable investment alternatives. Other than helping in the socio-economic development of the nation, financial intermediaries bear a large part of the cost that individuals and small borrowers should have shouldered it if they themselves had done what the financial intermediaries were doing. It is costly to do market research and analysis, including determining the most profitable and the safest means of investing our hard-earned savings. The big network of economies of scale available to these financial intermediaries allows them to shoulder all the costs, including transaction costs, which the individual and small borrowers should have shouldered. This makes the existence of financial intermediaries indispensable. In this connection, let us study the role of two market imperfections: transaction cost and information gathering. The financial market, just like any other market, is imperfect. An imperfect market is a market where information is not quickly disclosed to all participants in it and where buyers and sellers are not matched immediately. Even in the most advanced financial markets, there are still numerous cases of price corruption, improperly disseminated information, and other market imperfections. So first, in transaction costs. Transaction costs refer to all fees, commissions, and other charges paid when buying or selling securities, including research costs, cost of distributing securities to investors, cost of SEC registration, and the time of and hassle of the financial transaction. In general, the greater the transaction cost, the more likely it is a financial intermediary will provide a financial service. Banks and other financial intermediaries are experts in reducing transaction costs. Much of the cost savings come from the economies of scale and from the use of sophisticated digital technology. So the next one is information gathering. Financial intermediaries are major contributors to information production. They are especially good at selling information about a borrower's credit standing. The need for information about financial transactions occur when because of asymmetric information. Asymmetric information occurs when the buyer and sellers do not have access to the same information. Sellers usually have more information than buyers, especially when the buyers produce or own the asset to be sold. For financial transactions, issuers of securities know more about investors, about the credit quality of the securities being issued. As can be expected, informational asymmetry exists more for consumer loans and loans to small businesses because the little information is publicly available.